Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Frac Spread show. We're going to go through what's happening with the Frac Spread Count, what's happening with rigs, and then because we didn't have our EIA show because of some of the hiccups, if you will, that is happening at the EIA with their data, we went a little bit and we wanted to cover some of the key pieces that we're watching as we continue to progress into summer driving season, and what are some of the things that we're expecting as we go through the remainder of this summer, really, and into Q3 and Q4. And then we're going to just touch really quickly on some of the economic data, but we're going to do a deep dive this coming week, just because we had a lot of PMI data out of both the US and Europe, all of which are really confirming what we've been talking about on a big slowdown and now actual contraction in new orders and exports, and a lot of some of the key leading indicators when we're looking at really the health of the global economy. So without further ado, to our frac spread count, where we went up by 5. So we went up from 284 to 289, which, again, for those that have been watching, we've been saying that 290 was really where we were going to get to as we got towards the end of June. And really at this point, we think we'll be through 290 and much closer to about 295 as we really start to kick off July and we start to see some of this activity ramp closer towards 300. Because realistically, we're seeing about 300 through about 310 as really the likely range, with about 325 out there. Typically, you won't get to that number, especially because even though there might be 325 spreads available, it doesn't mean they're all available in the areas that may need them. Like with the Permian, as we were saying, for those that have been reading our research and listening to the shows, we said that 157 was the likely stopping point. We're right there. We're very close to that number, slightly above. And we think that that's when you start looking at the available spreads, the Permian is much closer to being sold out, where when you start looking at other areas in order to get to that 310 level, well, it may not be in the Permian, but it may be in the Western Gulf or the Williston or the Anadarko, where there may be some spare equipment. So one of the things that another place that saw some additional love was the Western Gulf. That's another place that we've been saying is really where we see a lot of the growth and opportunity, was really the Permian, the Western Gulf, and the Anadarko. Even with the increase of 5, we actually had some of the smaller basins coming down a bit. So that's where, when we look at this data, we can say, you know what, there is running room to see another 5 to 7 spreads over the next several weeks, especially as we get some of that seasonal bump, especially in some of the smaller regions. So again, all of this is just confirming what we've been saying. There's really nothing that has changed in terms of our views. This still puts us right on track to hit that 2.2 million barrel a day exit rate for 2022 that we've been talking about and targeting. This just really helps confirm that we're gonna be able to hit that level. And then another reason that we have this confidence is when you start looking at the DUC count, the drilled but uncompleted wells. One of the things that we were saying is, as we get into that May and June, you're going to see the rate of change really flatline and actually start to see some increases in DUC availability, or that drilled but uncompleted well availability. And here's some of that proof that we've been talking about, with the rig count going up by 13 in the US, 11 horizontals being added, 2 directional, 10 towards oil, 3 towards gas. And it's important because when you look at the rig counts have continued to go up. And even if it didn't go up, it stayed flat. Where the spread count is a bit more mobile. We've had some declines, but we've been kind of stuck around this level between, let's call it 280 to 289, while the rig counts have continued to progress higher. A lot of the additions were in Texas. We've continued to see some of this activity. And as we've been saying, the goal is really create that running room so that we can hit the ground in that June, July, August, mid-September level to really to complete the wells, make sure that there's enough of that production as we come on and as we get into the exit point. Because when you start getting towards the middle of September, as you progress different points, there's some decent amount of slowdown that will happen at different periods when we start looking at some of the different levels, some of the different problems overall. So those are some of the key pieces that we need to look at when we're discussing what is happening, where rig counts are going to go, and what that activity is really going to look like. Now, when we start looking at some of the different capacity, when we're talking about exports and what is happening in general, we really need to look at, okay, well, what is being exported in the world? What is being exported at this point in time? And that's when we start turning to what is happening in the OPEC market. So obviously here is when we start looking at OPEC plus, because we want to look at what is happening in terms of non-Russian and Russian. So clearly Russia crude is getting more and more is getting put on the water. They're actually starting to turn off their AIS transponders and again, trying to go dark, trying to hide where they're going. We all know it's going to Asia, so there's really not much of a surprise. But some of the key pieces that we want to look at are OPEC ex West Africa, and you can see where that shift is coming up. We expect more barrels to be on the water. We've been saying it in the EIA show. We expect the miles per ton to grow, which is just going to put more crude in transit, more crude on the water. So there's really not too much to say. It's just this is that confirmation that we've been talking about. And now China has slowed down some of their buying. We do expect that to ramp back up. As that ramps back up, you'll see additional capacity. But again, they have a lot of crude in storage that you're going to want to work through. But India does have a lot of needs. Now, when we start talking about refined product, I think it's important to remember that the refiners in the Middle East will process about 8.8 million barrels a day of crude in 2023, which is about 1 million barrels a day above the 2019 levels, which it should compensate for Europe. Again, the problem is, and especially for the U.S., the issue is you're now trusting the fate of your, the sustainability of diesel demand, of diesel availability, gasoline availability to Saudi Arabia, Kuwait, Oman, Iraq, Bahrain. So when you start thinking about, okay, well, how much of this can we really rely on? When you look at Kuwait, which ramping in the coming weeks of about 600,000 barrels a day. Linjiang in China is at about 320,000 barrels a day, has started to ramp already. But as we shutter things in the U.S., as we shutter capacity in Europe, you're now beholden even more so to the Middle East, to Asia. And if China turns around and says, we don't really feel like exporting right now, it's like, well, where are you going to replace that? And we were actually getting that right now. There's a lot of spare refined product in China. They've still continued to kind of hinder some of that. So those are some of the key pieces that we're going to get to. But there is refining capacity coming on. Some of it is operational, but again, how much do you want to trust some of this or making it available, or is some of this going to be pushed into the Asian market? Obviously, the Atlantic Basin is going to attract the lion's share of it because the ARB is wide open. Some of these facilities that are coming on are actually weighted towards more distillate and more diesel, which will be a net positive just because diesel is where we have the steepest shortfall. And so that will help alleviate some pressure. But again, there's still those issues in terms of how short we are on storage of the diesel side. Gasoline is a little bit of a different picture, not as dire as it is on the diesel distillate side. So those are going to be some key pieces. Retail gasoline prices started to roll over, but you can still see they're right around $5. I always think it's important to put it into context against 2008. The last time we had that, I think an equivalent type of slowdown. Now, this is some of the things to pay attention to. Obviously, we're much higher than we are before. Refining processing capacity in the U.S. is very different when you start looking at some of the different availabilities between the different periods. But again, when you look at where demand could go, where the pain could really be, you get an idea of how steep that drop can be. I am by no means saying it will be the same drop. I just think it's always important to keep this in mind when you're looking at gasoline prices, because we are a bit more concerned on gasoline prices and we're more constructive on diesel. So when you look at diesel, it's important to also appreciate that you can get that drop off as well. We are structurally in a different place. And when you look at middle distillate and how you make diesel, the available crude quality that is heavy in distillate is more expensive. There's not as much of it. We haven't been producing as much heavy crude. We haven't been exploring and focusing on that cut where light distillate, the light distillate can be made from some of the lighter crudes, where the heavier the crude, the more middle distillate is there. So you're creating some of these shortfalls, which is why things are a bit structurally different when you look at gasoline versus diesel. Now, we're starting to see some of the pressure. We're starting to see some of the diesel demand slow down. But we do expect demand to come down, but there's more of a supply problem on the diesel front than the gasoline front, globally speaking. When you're breaking it down, there's a diesel issue, and that's where we see some of that pricing support. Here's some of the key pieces when you look at diesel demand, especially on the trucking side. Clearly, things have started to flatline. We're still well above historics, but things are moving in the wrong direction when you're looking at diesel demand, which is why when you start looking at the demand shortfall, that'll help kind of bridge some of that gap. Year-over-year change in FedEx, I think, is important because when you look at average daily growth volumes, you're starting to see that volume come down. And this is important because revenue per package has gone up, average daily volume, and that's why and for those that have watched our econ show, I've said it multiple times, there's a difference between volume and value. The value can go up, but it doesn't mean that the volume is, because again of that inflation and that price jump. So this is why it's so important to look at the volume side to say, okay, well, the value could go up, but are you moving less stuff? Because then it means you're going to consume less diesel, you're going to consume less gasoline, you're going to consume less on the refined product side. And all the while, ticket prices now, don't get me wrong, for anyone who has flown, it is a nightmare. Flying was always a stressful period. They've made it 10 times worse, and now they're charging you an arm and a leg to experience the pain. So again, that's why we do expect to see more slowdowns. And again, it's an income scale. People are looking at this saying, I'm not flying because it's terrible, it's too expensive, I'm going to drive. And then those that normally drive are looking at this and saying it's too expensive, so I'm not going to drive, or I'm going to drive less. Again, that income stream, but people not flying and instead driving is going to put some of that support, which is why we've been saying we're not going to get this huge collapse of gasoline demand, but really that 9.1 to 9.3 million barrels a day kind of holding firm, which is going to underwhelm versus the normal seasonal bump, but again, kind of sit within this fairly tight threshold. And here you can see the TSA passenger data showing what we've been saying, where things are just kind of holding below what is deemed quote unquote normal, seasonally adjusted, as you can see, as people avoid the skies. But obviously more than 2021, but not back to normal. And that's going to continue to be the case given some of the pain. Now, when we start looking at that inflation-adjusted total credit card spending, I think it's important to say, when you look at it, this is that value versus volume. People are starting to use their credit cards less. So when you look at calculations, inflation-adjusted total card spending has slipped into negative territory for all three income groups in May. And this is some of those key pieces when you're looking at how is the consumer doing? How are they spending? Are they spending more or less? Well, we saw retail sales, nominal and real, go negative. And here you're seeing that continuation, which is something that we think happens through June. All the while, when you start looking at how is that impacting some of the outlooks, you're seeing some of the forecasts finally starting to move down and going negative as we go into June and beyond, which is where we think some of the pressure is going to remain as GDP continues to get revised lower as, again, the data comes out. And then here, and just as a brief summary in terms of German PMI orders and inventory, which is that dotted line, is now negative. It is in contraction. And then US PMI orders and inventory are also in contraction. Again, all of these things are showing. Now, the problem with Germany, we're going to cover it, and it happened in Germany. It happened in the German data, the French data, now the US data. All of this is showing contraction, and especially in Europe, it's not just slight contraction. It's not like we're at 49, 49.5. We're talking about things that are 43, which is, again, there's no question in terms of the direction that's going, which is why we continue to see this pressure in both the U.S. and Europe, which again is going to weigh on the consumer, is going to weigh on activity and underlying economic growth. So that's what we have for you today. Keeping it a little bit shorter, under 15 minutes, thankfully. So hopefully you can get to your weekend. Hopefully you have a lot of fun and exciting things planned on this summer. I think it's the first summer weekend at this point. But anyway, we hope you have a great weekend, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.